there have been questions from basic economic terms in previous ESE papers. Now let us have a quick rewind of the terms, so it will be helpful for the last minute revision. First, let us see about the receipts and expenditure. So in any budget, there will be incoming and outgoing part. So this incoming part is called the receipt and the outgoing part is called the expenditure. So if we see in terms of the budget of the government, there are two headings, one under receipt and expenditure. So there are different types of receipt and expenditure. So it can be classified as revenue and capital. So this difference you have to note. Revenue essentially means that it is like one way. The party who is receiving it need not pay back. For example, if you get your salary, it is your revenue because you don't have to pay it back at a later time. But at the same time, if you are taking a loan, that time also you are getting money. But that loan you have to pay back at a later time, right? So it is not revenue. It will be in capital. So this is the basic difference. So revenue, you remember, like it is one way. What could be the revenue of a government? Mainly there are three types of revenues. One is tax, second is non-tax, and third is other type of revenue receipt. Tax is one of the major source of income for the government. Tax means it is getting from the corporates or individuals or through service tax, sale tax, etc. So this tax, it is the payment to the government. Government don't have any liability. Only we can otherwise tell it like liability. There is no liability on part of the government. So tax, for example, we have customs tax on the imported goods. We have goods and service tax combined. Now, then we have income tax on individuals and income tax on corporates, or we can tell like corporate tax, but it is income tax on the business units. So different types of taxes are there. In non-tax, there comes taxes other than, in non-tax it comes revenues other than taxes. For example, if the government has given loan to somebody else and they will get interest, so that interest comes under revenue. Even though loan is coming under capital, interest of the loan comes under revenue. So this difference you note. This is like a one-way payment, right? So it is revenue. Next is dividends and profits. Government have a different organization. They are profit making organization like public sector units like Indian Oil Corporation, BHEL, etc. So they will be sharing their profits with the government. That is dividend. It is the share of the profit to the government. That is also a revenue receipt. And what is the difference between dividends and profits? If the company is 100% owned by the government, it is profit. It don't have to divide and share. If the government is not having 100% but some 50-60% of the share in the company, then the total profit will be divided among the shareholders. Then the government, what the government getting, we will call like dividend. That is the difference. Other revenues are there. We will pay fines, we will pay fee for government services. Small fees are there, right? All these fees, receipts will be collected, will come under other revenue. Now we can go to the capital. What is the capital receipt? It is of two types, debt and non-debt. So capital is whatever it is having a liability. It is like two-way. It is a two-way. For example, debt. Government is taking loan from somebody. So after some years, it has to pay back. So it is two-way. And non-debt revenue can also be capital. How it will become two-way? For example, government is having some land or a company or public sector unit is there. So it is an asset to the government. So for making this asset, government would already have put some effort and money, right? So money has come here. Now government is selling out this asset, means this money is going out. So here two way. First, government would have put its efforts to create this asset. Now it is selling and getting back money. That is also capital. It will come under the non-debt. Loan recovery means government would have given loan to somebody else, and if it is getting back the loan, that is capital, because earlier it has invested in this. And next is disinvestment. Disinvestment is it is selling out its asset, especially the public sector units assets. If it is selling share sales or outright sale, total unit like that, government can sell to other party, then government will get some money, that is on time payment, that is capital. Debt. Debt is also a capital. It can be two types, internal debt and external debt. Internal debt means government is getting money from within India. That is, RBI may be giving loan to the government. When does RBI give money to the government? For example, if budget allocation is not enough, government is running out of money, or government has just formed, full budget is not presented, but for expenses it needs money. So in that kind of situations, RBI will give short-term loans to the government. It's called as way of means advances. That is one form. Other form is government securities. We have discussed this in our lectures before. Securities. Government will issue securities on the promise that it will pay back the money later. That is the predetermined rate. And bonds. There are different types of bonds in the market. Government can also issue bonds. Government bodies can issue bonds, like municipal bodies can issue bonds. So there are different ways in which this debt money can be accounted to the government, because government will be borrowing both from institutions, financial institutions like RBI, or from even public, like by the way of securities, and public savings will also be invested in this security. External means if the government is getting money from external agencies like IMF, World Bank, etc., then it is external debt. And if they are giving aid, sometimes poor countries and developing countries will be given aid by these development organizations. That time this aid can, if it is used for capital, it can be called as capital receipt. This external debt means it is not aid, we have to pay back. So if it is for capital thing, we can account it in non-debt capital receipt. We saw receipts and expenditure. Whenever there is a mismatch between these two, it is not balanced. So it is unbalanced. So aim of any budget is to make it balanced, to cover the expenditures with the receipt. So it happens even if in our personal budget or even house budget or even a national's budget, this will happen. But what if the receipt is less than expenditure? Then it will be called as deficit. If receipts are less than expenditure, it is a deficit. We have different accounts, right? Revenue, capital, etc. So accordingly, we have different types of deficit. If it is total receipts minus expenditure will be more. Total expenditure minus total receipt is the budget deficit. So here total means both revenue and capital will be accounted. What is the difference? It is the deficit. We can tell, accordingly we can tell like zero deficit budget, deficit budget, excess budget, like that according to this calculation. Next is revenue deficit. Revenue especially mentions about the revenue part. So total revenue expenditure minus revenue received. So it is taking part of only revenue. So what does this mean? This has great implications in an economy. That means if the expenditure is more than the receipts we are getting, revenue receipts we are getting, government is running in losses. If it is a corporate, we can tell like it is running in losses because income is less than the expenditure, right? So where it will find money? Because for this revenue, it's like running expenditure. Government has to pay salaries, government has to pay pensions, right? So how it will find money? So it will eat from the capital of the government. So whatever the capital assets government is having, it has to use it. Otherwise, it has to borrow. So either you have to sell out the assets or it has to borrow to meet this deficit, because we can't run without a deficit, right? We have to find somehow the way to balance it. So this is an important term. It has great economic implications. So for calculating how much is the borrowing, we have another term like fiscal deficit. So this fiscal deficit denotes borrowing and liabilities. How? This is the total expenditure minus total receipt, but this receipt does not include borrowing and liabilities. Normally in a budget we will show it like a balanced budget. How? The deficit will be shown as external borrowings or selling of assets. So somehow we will get money and the budget will be balanced in almost all the cases. So that cases budget deficit will be 0. And how we know that, how we are balancing it? So this part we do not account. So it will show the actual deficit. Actually these terms are similar if you are not borrowing. If you are not borrowing any money, these two will be similar. If you are borrowing money to make the budget balanced. So the point is here, if you are borrowing money to make the budget balanced, that borrowing money will be reflected as the fiscal deficit. So during budget operation and all, the aim of the government is to keep the fiscal deficit as at a particular limit. So because we are seeing that increasingly government is keep on borrowing to meet its expenditure, so it is an unsustainable process where it will end. So there is an act, FRBM Act, that has set targets for the fiscal deficit. So this year we have to keep the fiscal deficit within 3% of the GDP. Like that limits are set because we have to take care of this part. So to know how much the present government is creating the deficit, so we have to come out with a term, another term, because this deficit will include interest payments also. So the total expenditure will include interest payments for the previous loans that we have borrowed. So it will be borrowed by the last government, right? So this government is not responsible for that, but still they have to pay the interest. To know what is the proper deficit made by the present government or present budget, we will go for primary deficit. Primary deficit will be fiscal deficit subtracted by this interest payments. So it is only for comparison of the economic status. So we will subtract the interest liabilities and find the primary deficit. So if you are not able to stick to the deficit targets, we will tell like it is fiscal slippage. Say 3% of GDP we have targeted, but it has come around 3.2% of the GDP, then we are not meeting the target. It is called as fiscal slippage. What is meant by fiscal consolidation? The long-term steps that we are following to contain this deficit. So that long-term strategy to contain the deficit is known as fiscal consolidation. So these terms you will see in the news. So you may be confusing between these terms. So now make it clear. It is about the steps taken to keep the deficit at a particular targets, and slippage is if you are not adhering to the targets, it is a fiscal slippage. Now let us see sometimes associated with the taxation which comes in news frequently. So we are not going to the details of the taxation, but let us see some important terms. Cess, you will hear this term. What is cess? Cess is the additional tax. For example, we already having 10% GST. Imagine we already having a 10% GST, but government is imposing 3% cess. What does it mean? It is 3% on this 10%. It is 0.3%. So additionally the customer or consumer has to pay 0.3, additional 0.3, 10 plus 0.3, 10.3 tax they have to pay. Why this is imposed? It is imposed for specific purposes. Specific means usually what happens to this tax amount collected, it will go to Consolidated Fund of India. So it is a common fund of the government of India. So the expenditures will be met from that consolidated fund. So all these tax revenues will go there without any differentiation. But if government wants to allot money for specific purposes like giving free education to students or environmental protection, so government will impose cess and it will not go to that common fund, but it will remain as separate, and government is authorized to use that money only for that specific purpose. Surcharge is also a tax, that is an additional tax. So it is different from cess. It is like normal tax only. For example, if the income is exceeding 75 crore, there is an additional tax. So normally income will be charged on say 10%, but when it is crossing a particular threshold, there will be an additional rate. So income in excess will be taxed as 20%. So this is called as surcharge. What is duty? Duty is also a type of tax, but it will be imposed on goods. Import and export of goods or manufacture of goods, that is called as duty. Countervailing duty means during imports, some countries will be giving subsidies. For example, here in India for agricultural production, we have lot of subsidies, right? We will give fertilizer subsidy, we will give power subsidy to the farmers, so that the production cost of the farmers is less, and so the output cost will also be less. If other countries there which is not giving any subsidy to the farmers and their cost of production is higher and their product cost also will be higher, when India is exporting to that country, the price of the agriculture product exported by India will be less than their domestic cost, right? So it means that their domestic farmers are at a disadvantage because low cost products are available in the market. So for countering this, so for protecting their domestic farmers, that country can impose countervailing duty. So whatever is the amount of subsidy that is given in India, they will impose it as duty here, so that the prices will become comparable and it will ensure the fair competition. That is the purpose of countervailing duty. So in news, you will see India will be imposing countervailing duty on certain products like steel, etc. once in a while in the news. And another related term to this is anti-dumping duty. So it is also related to imports. This duty is applied when the government feel like other countries exporting goods at a lower price purposefully. So their cost of production may be higher, but for purposefully conquering the market, they will sell it as a cheaper price. So what will happen? For example, Chinese products are flooding Indian market, right? We get cheaper Chinese plastic products, plastic toys, etc. But at the same time, Indian manufacturers are not able to produce at that cheaper rate. Similarly, solar panels. So many things are coming from China. So this is called as dumping. So the China is dumping goods in India. So preventing this and protecting the domestic manufacturers, Indian government can impose anti-dumping duty. So it will impose certain taxes on the import so that prices won't be that much cheaper in the market. Now let us see about the capital market. Capital market is the place where long-term funds are raised. It is long term. The importance here is the long term. So there are different players in this market. For example, stock exchange is there, banks are there, RBI is there, SEBI is there, non-banking financial institutions are there, then securities are there, and development institutions are there which will give fund for investments, etc. So many players are there. If we see capital market, there are different divisions in that. In that we can see the securities market. So what is meant by security? Security is nothing but an agreement that when we are giving money to somebody, they will be giving back the money or they will be giving back the profit or dividend. So that is a security. So when government is issuing security, we will call it like treasury bill. Government securities are called as treasury bill. So for among the securities, because securities can be issued by both government and also private parties. If any person, any company wants to raise money, they can issue securities. In the securities market, government securities are more secure. It is sure to get repayment at the promised time. So it is most sought after securities in the market. So when we tell about securities market, it is composed of shares, debt instruments, etc. What is share? Share is an agreement that agrees to give a part of the profit to the person who is investing. It is like investing in a company. So I am putting money in a new company. I am expecting that the company will make profit and I will get the profit share. Here I am not expecting the money to be paid back. So whatever the money I am giving, it is not the money that is paid back, but the profit out of the operation I will be getting. So there are different types like equity shares, preference shares, derivatives. So equity shares are whatever is the profit and loss, we will bear it. So if it is loss, we won't get any money back. If it is preference, preference means it has more priority over equity because some payback is assured in the preference shares. Derivatives are those instruments which are derived from the underlying security. So their underlying security will be there. Derivatives as such don't have any existence. Say on securities, there on person is holding some share in company and he will be selling it to another person. Like for example, futures means in future I will purchase this from you. In future I will pay this amount. Or in future you give the share, I will pay you some amount now. Some agreement derived on the underlying security is called as derivatives. So this derivatives market is also there. So here comes future trading, options tradings. Difference between futures and options is that futures is more secure and options is less secure, because option, these parties have option to go back from the agreement, but futures don't have that option. So these features and we will see in agricultural markets. So before the agriculture harvesting is done, the farmer may need money. So he will put his commodity in the futures and in the agreement that future he will supply the commodity, like that. Some agreements which is derived on the basics, some say basic security is called derivative. So derivative market is thrive on that. What is debt instrument? Shares and debt instruments are different. Debt instruments are different from shares because it does not assure any share in the profit. It is just like giving loans. Once we give money, they will give back the money as at the determined interest rate. So the bonds, if you are investing in any bonds, it means that we will get back that money after some time. So among bonds and debentures, debentures are more secure. So if you invest in debentures, it is more secure than the bonds. Bonds, we may not be that sure whether that party will be paying back or not. For example, if you are putting it in a Municipal corporation, if they are not getting enough revenue, how they will pay back? There is no much assurity. So bonds are also rated in different categories to give an idea to the investor which is the most reliable bonds. But the debentures come with some security. They will get back the money. So when the company is going to losses, they will first pay off the debts, then only they will pay off the shareholders. So that is the difference between these instruments. So both are traded in the securities market. The security market itself have two types, primary market and secondary market. Primary market means for the first time if the company is going to issue the shares or bonds, it is called primary. So that shares has not existed before, it is first time. So when the first time, if the company is going for public shares, it will be called as initial public offering. So this term also you will hear in news. Some companies will go for initial public offering. That means they are, for the first time they are going to sell the shares to the public. Public means anybody can participate. Anybody interested can buy the shares. So there will be advertisement in the newspaper and media. Accordingly, they can see the advertisement and buy the shares if they want. That is public. And this can be private also. Private placements means they will select some specific individuals or specific financial institutions or corporates, so that they will give the first issue to them only. So only for selected persons. This is for mainly new company if they want the assured investment, and for trustworthy people they will select, and those people will only be given the issue. Rights issue means it is given to the already existing shareholders. For example, if my company has already some 3-4 shareholders, I want to expand my company. So that expanding amount, first I will give to these people who are already the shares. If they are willing to buy more shares, first I will give preference to them. Then only I will see other methods. So there are different procedures involved in the issues of these shares. So once there was a question like which is the most easiest method to give. So instead of finding investors, we can go to private placement or rights issue. It will be more easy for the party to raise money, right? Other than this also there are different types of shares, like giving shares to the directors, giving shares to the employees. So it will come with different names. So these are the primary issues. Once these shares come into market, it can be again traded. That is what happening in the stock exchange. So the secondary market is similar to stock exchange. It is synonymous to stock exchange. Here once traded shares will be traded again. That is, I bought some shares from Tata. Now I don't want to hold it. Where I will sell? The company is not willing to buy back the shares now. So I will go to the secondary market, that is stock exchange. I will sell the shares there. There will be other people who is willing to buy the shares. So according to the market demand, it may be selling at a higher price, lower price, etc. That are all different calculations. But we can trade these things in the secondary market. Next topic is external trade. So when two countries or country between another multilateral institutions like World Bank are exchanging goods or services or money, it will come under the external trade. So there are sometimes related with this external trade like balance of payment, current account, capital account, etc. So let us see what are these. So balance of payment is the account of all transactions. There are different types of exchanges happening between countries. It can be trade, it can be investments, it can be remittance, etc. So what are all the transactions happening? If you are taking the difference, it is called the balance of payment. So what are all outgoing should be equal to the incoming. It is balance. If it is more, we will tell like it is surplus of balance of payment. So balance of payment is the total incoming minus outgoing of all transactions. That you have to note here, that includes all type of transactions. So accordingly, we can classify the transactions into different types. What are they? Current account transactions and capital account transaction. So this is similar to the receipts that we have seen before. Revenue receipts and capital receipts we have seen in the budgeting. This concept is similar. Current account is similar to the revenue receipts and capital account is similar to the capital receipts. So current account is what are coming under the one-time payment. For example, export. We are exporting some goods. We will get back some money. Import. We are paying money. Invisibles. Invisibles are that are traded as services, investments, etc. So this export and import we can see as goods. So we can see the physical goods being exchanged. But without being exchanged of goods also certain transaction happens that comes under the invisibles. For example, services. For the services we are offering, we will get paid. And we may get income from abroad. So I may be investing in some company abroad and I will be receiving the dividends or profits from that company here. That is income. And the government or any institutions may be giving loan outside and they will be getting back the interest. That is also income. And I myself will be going abroad and working and sending money to my family. That is remittance. So this is the product of labor. The person himself or herself going to an outside country, earning money and giving back to the home country. That is remittance. So remittance is one of the major source of income for India, and India is one of the largest recipient of the remittance in the world. There can be transfers other than this also. So this all will come under invisibles and it is calculated in the current account. Whenever there is a deficit in the account, we will call like CAD. So this CAD will come in new sense anyway. It is current account deficit. It is related to the trade. Next is capital account. Capital account will include assistance. Assistance is what government is getting assistance in the form of loans from other countries. Bilateral loans, that is loans between two countries. Multilateral loans between multilateral institutions like World Bank, IMF, etc. to the government. So the bilateral and multilateral loans to the government will come under assistance. Other than government, private players can also take loans. They are called as external commercial borrowings. So there are certain limits and conditions set by the regulatory institutions, how much amount and how much whoever can take this borrowings, but it is there, provision is there, that is called as external commercial borrowings by private players. And then comes investments. So we are getting investments in different forms. For example, FDI is there, foreign direct investment is there, foreign portfolio investment is there, foreign institutional investment is there. So these are the different methods that investments will come to our country. So these are all capital account. So what happens normally for a country like India? The exports are less than imports. So it means there is an imbalance, that is imbalance in the trade. So when we are accounting only the imports and exports called as trade balance. So this you note. The term trade balance means exports minus imports of. So the current account balance includes both trade balance plus invisible. These two accounted together is the current account. So normally in Indian scenario we are running on current account deficit. We are not able to get the money that we are spending in the external trade. So in such cases, how we are managing? We are managing from excess capital account. So we are getting more capital account balance by the way of FDI, FPA, etc. And this will balance the balance of payment. So the balance of payment includes both current and capital. So more capital will balance the current deficit. That's why FPA and FDI are very important to India. That government is pushing this, like make India more attractive for this investment, because there is already imbalance in the trade. For countering that, we are going for this more capital account inputs. And what happens? What happens when we get more balance of payment? It will go to foreign exchange reserve. Every country will be keeping some amount for security, for buying the essential things. So that amount will be managed by the central bank, and this excess amount which is coming will get added to the foreign exchange reserve. So what happens when we are not getting enough money? What we will do? We will be consuming from the reserve. So we have to maintain a certain amount. If it is going beyond the reserve, we will be in a difficult situation. We will be going to bankruptcy. We will not be having enough resources to pay back the loans. We don't be having enough resources to run our daily needs also, right? We are, for example, in India, we are dependent on energy needs, petrol imports. Earlier, before Green Revolution, we were dependent on the food imports also. So it is a very difficult situation. When such a difficult situation happened only, we went for the 1991 economic reforms. So on the condition, that was a conditional reform. When we went for more assistance from the multilateral institutions, they put a condition of economic reforms and we got the external assistance to tide of this difficult situation. So this foreign exchange reserve will be maintained, and the rate at which different currencies are exchanged is the foreign exchange. So there is a similar term with this foreign exchange. Foreign exchange means that is the rate. Foreign exchange is the rate at which, like for example, for how many rupees we will get on dollar, that rate is called as foreign exchange rate. Foreign exchange reserve is the reserve we are keeping. Now let us see the topic privatization as the last topic in this lecture. This is important because nowadays we are seeing in news government is going for disinvestment of the public sector units. So it is coming in news once in a while. So this topic is important. What is meant by privatization? Privatization, the name is clear that it is managed by the private parties. It is related to the private parties, not the public. So it is opposite to the public management or public industry, nationalization, etc. About going towards privatization in the economy. So what are the two types of privatization that is adopted for the public sector units in India? Two types are one without changing ownership and one with changing ownership. So this privatization can be achieved in two ways, with changing ownership and without changing ownership. So changing ownership is what we are now seeing in the news through disinvestment. Disinvestment means government will be selling the shares that they are having in the public sector units, so that government will be no longer in the management. It can be done in two ways. It is partial and total. If it is government is going for partial disinvestment, it does not make much changes in the management. There will be some changes. For example, if government is holding 75%, for example, if the government is holding 75% share in a company and it decided to sell shares up to 51%. So remaining shares it will sell. Difference it will, but it will hold 51. So it will remain as the majority shareholders. So here the term is majority shareholder. Majority shareholder will be having more voice than the decisions of the company. So in the management will be according to the shareholding. So whoever is holding more shares will be having more representation in the management. So still government is having majority representation in the management. So still it remains a public sector unit. So it designation will change. Still it remains a PSU. But government will be selling some portions. It is partial disinvestment. So many PSUs are now going for strategic disinvestment. And some PSUs are going for total disinvestment also. This government don't want to hold any share. It want to bring back the shareholding to 0% means it will be completely going to the private parties. That is total disinvestment. It can be done through different ways like sale, outright sale. So say for example, Air India itself, government is trying to sell Air India as itself. So some business person who is capable of taking up this corporation, he can buy and run the operation as a private entity. So it is outright sale, selling the whole unit itself. If it is like not For example, Air India, there are other players, right? They are doing the similar operations. So we know the market price of this entity, how much it is worth in the market. If it is not like that, if it is a single company run by a government, for example, I am telling one example, ISRO. So if the government is trying to sell ISRO, how we will price it? We don't have any other similar institutions like that. So in such cases, we can go to bidding. So whoever is giving more bidding, we can sell the company to them. Structure will change. Let's say the ownership will be changing. So this disinvestment, normally what happens? Private companies or private corporations will be buying the share. So for example, if government is selling some share in the HPCL, another company will be buying it. Another company like IOCL or ONGC will be buying it. So if it is given to public like common people like us. So it happened in United Kingdom. They gave the shares of the institutions to public, like a public offering in shares. Then we can call it like democratic privatization. So instead of any private cooperatives or private players, public will be buying the shares. That is called as democratic privatization. So what is the purpose of this privatization? First one is raising resources. Government needs money. So disinvestment is one of the way to get the capital receipt, right? So if the government is running out of capital receipt, it can go for selling of its shares. That is the way of raising resources for the government. Second, government will be wanting to increase the participation, public participation in the management of the companies. Other private parties will come, they will come with their own expertise, etc. So it will be advantage to the company also. So instead of going through the old way of managing, more management techniques and more expertise and more resources can be put in. So it will improve the unit. And third is improving the performance. So when we are bringing in more management changes, more resources, etc., the accountability of the company will also improve and the performance will be improving and the government will get more profits or more dividends. Government will get more dividends, right? So these are the main intentions of the privatization. But now what we are seeing is main intention is government want to raise resources, plus government don't want to involve in any other business. Government want to concentrate only on the governance part and essential public goods like transportation, education, health, etc. So these are like side business for the government. Government don't want to waste their resources there, so they want to get out of this business. That is the two reasons that we are seeing behind the disinvestment right now. Now let us see the other one, without changing ownership. How this will happen? This can happen when we are giving more autonomy to the public sector units. So it was done through certain memorandum of understanding. So this was recommended by Arjun Sengupta committee, this idea, so that there will be an agreement between management and the government, that certain performance parameters will be set, certain operating parameters will be set. According to that parameter set, according to the condition set, within that condition set, the company will be given autonomy to perform. So the management decisions, they do not depend on the government. They can take their own investments, expenditures, expansions, mergers, acquisition, etc. So what are the operational requirement? The management is free to adopt without getting government consent. But overall it will be guided by some MOUs. They will be working within that agreed parameters. So that was on method to bring in autonomy to the public sector units. So accordingly we saw that many public sector units were given autonomy status like Mini Ratna, Maharatna, Navaratna, etc. So depending on their performance and depending on their turnover and depending on the financial capability of the PSU, different types of status are given, and according to the status they will get more autonomy. So Maharatna companies are more autonomous, they have more autonomy in their operations. So this is also one method to achieve more accountability, more efficiency in the operations, and government need not involve in the day-to-day affairs of the company. So it will according to this principle also, government don't want to be in the daily business, right? And government will get the dividend also, whatever the profit they are making, government will be get dividend. So it is like a mutual beneficial for both government and the company, and more profit to the government, and at the same time less involvement of the government. So this is called as cold privatization. Cold means government is cold towards the happenings. It does not involve in the happenings. Cold means distant. It will be at a distance. That is this one, by giving more autonomy. Another type is greenfield privatization. Greenfield privatization means government allows competition in the market. So market monopoly is avoided. So earlier what happens, there will be only government units performing. For example, now in railways, defense, etc., only government is the sole player, right? So there is a monopoly. So if government is doing away this monopoly and allowing the private players to come in the market, there exists a competition, there comes a competition, and this competition will drive the public sector units to more efficient units. So this kind of this greenfield privatization means it will give license to private players. Delicensing means earlier license was required to enter into certain enterprises. For example, communication, they need license. Now there is no requirement for licensing. It is delicensed. It means any private player can enter into the communications. So BSNL, like that BSNL faced severe competition, right? So according to the capability of the organization, it can either survive or perish. Creative destruction, free market principle, that is whoever is able to survive will survive, whoever is not efficient will perish, that's it. And de-reserving, before certain areas were reserved only for the government. For example, defense, railways, etc. was only for the government, no private players were allowed. But nowadays we are seeing that slowly de-reserving is happening in those fields also. Defense manufacturing also given to private players. So there is another method, FDI, attracting foreign direct investment in this area, so that private management and other outside management will be coming to this field, so to create the competition. So by creating competition also, it will achieve the same results that we have discussed before, improving efficiency in operation and raising the resources.